Good morning and welcome to this Monday, February 14th, 2022 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. First, happy Valentine's Day to everybody. Hard to believe February 14th, already a month and a half into 2022. It's been a rough month or a rough month and a half. Probably going to get rougher, I think, this quarter. We got a lot of challenges, a lot of headline news that's not good, a lot of technicals that were rough coming into the year. They're getting worse by the day. So I think we got some problems ahead. Good news is I see many brighter days ahead, but we just got to get there. It's kind of like you just got to kind of cross this bridge, and it's going to be a rough period while we try to cross it. Let's go ahead and for those of you who are new to EarningsBeats, let me take you over to our homepage. If you go to EarningsBeats.com, if you want to learn more about us, just scroll down. We've got our free EarningsBeats Digest newsletter right here. All you have to do is type in your name, email address, hit that subscribe button. We publish this newsletter 3 times a week, Mondays, Wednesdays, Fridays. Usually it's a pretty quick read, just a couple paragraphs and a chart. No credit card required. It's completely free. You can unsubscribe at any time. It's just a way we give back to our community, all the folks that listen in, read my articles, and do things like that. Just want to give back something. So definitely go in and sign up. The other thing, the really neat part of this feature of this is when we do free events, we reach out to this community. In addition, obviously, to all of our paid members. But anyone who's in this EarningsBeats Digest community, our free newsletter, also will get an invite to our free events. And we had one of those just a couple of weeks ago, which was our January effect. If you go back to the homepage here, you'll see this February educational series. Three events in the series, Saturday, February 5th, Saturday, February 12th, Saturday, February 19th. These 3 events, the first one, the January effect, was a free event. If you missed it, you can actually just go in when you hit that link. It'll bring you to this page. There you can see the 3 events. Saturday, February 5th was our January effect event, and you can click on this link right here to get the recording. So even if you missed the event, this is still a free recording to everyone. Just a quick synopsis. If we have a rough January, the tendency is, not a guarantee, but the tendency is that we have a rough rest of the year, or that we don't do a whole lot. Rarely do we have a really bad January and follow it up with a really good year. That's very rare. So anyway, if you want to learn more about that, you can click on that video and watch that. Our second event was this past Saturday. I thought it was phenomenal. Got tremendous feedback from it. I'm really happy that a lot of folks felt like they learned quite a bit about the market. You know, the stock market really is a place where you see history repeat itself over and over and over again. Things might be slightly different, but a lot of times the drops when you go through these cyclical bear markets, they can be very similar in terms of severity, in terms of duration, and so forth. So that's what we wanted to share with our EarningsBeats community, especially, well, our paid members. This took a lot of time going back, studying history, putting together all the charts. We broke it down by decade. We showed you what these cyclical bear markets look like, because to me, you've got to keep things in perspective. I know right now, market seems horrible. It seems absolutely awful. But from the bottom in March of 2020 to where we just topped, we went up like 110 or 120% in less than 2 years. That's when a lot of these cyclical bear markets will come in. The stock market's not going to go up 110% every 2 years. It's just not going to happen. Our GDP doesn't grow that fast. And maybe there are certain companies that can, really pick up the ball and run with it. Maybe they're deserving of going up 100% every 2 years, but not the entire market. And so we just get to a point, and Wall Street sends us signals, and I'll show you some of them in just a couple minutes. But the whole idea of this event was just to kind of bring perspective in and let members see in the past, as you go up, you have these big moves, but then you also have these, 20, 25, 30% pullbacks from time to time, and it's okay. Doesn't feel okay. You think you're going into Great Depression 2.0 every time you go into one of these, but you've got to keep it in perspective, and then you have to have patience. You got to let this thing run its course. When you're in a market that's going up 110% in 2 years, every time you have a little bit of a drop, you buy, and then it goes right back up again. And that works perfect in that environment. In a cyclical bear market, you're going to drive yourself to the poorhouse. If every time you get a little bit of a pullback, you buy, you might get a quick bounce, but chances are in a bear market, you're going to see lower prices fairly quickly. So you got to be careful and resist the temptation to say, oh my gosh, this stock was $120 and now I can get it at 95. Well, if you wait a couple months, you might get it at 65. So you got to have patience. So I thought this event was really good in terms of just going back, studying history. Market was closed. We took some time just to kind of relax and check out what we might expect over the course of the next few months. And I'll be honest, I don't think it's going to be pretty. I didn't think it was going to be pretty to start the year, and I still don't think it's going to be very pretty. But if you can maintain your portfolio balance or at somewhere close to it, or even maybe make money while the market's going down, your purchasing power goes up tremendously. You don't have to be on the short side. Although if you want to be on the short side, I have no problems with that while the market's going down. The problem is a lot of times Wall Street doesn't hold up a sign and tell you when the bottom's hit. So, if you get on the short side, you just start thinking this is how you're going to keep making money. And before you know it, the market turns. And for me, the worst thing in the market is being on the short side when the market's going higher. That drives me crazy. I guess everybody has different trigger points, things that drive them nuts. That's the one that gets me. I don't like being short when the market's going up because I'm a overall pretty positive, pretty bullish kind of investor. And so being short when the market's going up is just the worst thing for me. Anyhow, this Saturday, we have another event, and that's going to be the most overlooked growth stocks. So I thought this was perfect, kind of a series. January effect telling us things are going to be bad. Cyclical bear market going through, talking about history and what we might expect. And then looking for the growth stocks. Because if we spot the bottom, spotted the top, if we can spot the bottom and get into the right growth stocks, usually coming out of an inflationary period, growth stocks explode. And so this is something I think we've got to be aware of and be thinking about now, not after the market's gone up 15 or 20%, but we need to be starting to put together our game plan, doing our homework now. And so this weekend, I'm going to be talking about some of the growth stocks that I think people have overlooked and that are still showing signs perhaps of some accumulation. And when the market bounces back, I expect some of these companies to do extremely well. So that'll be this Saturday. So if you want to join, you can still sign up, 30-day free trial at EarningsBeats. If you go down to the bottom, you'll see a form here. We'd love to have you. I think it'll be another great event, at least give you something to think about as we head into what is probably going to be a pretty rough period ahead. Also, we have our draft for our portfolios coming up. This event on the most overlooked growth stocks is Saturday, February 19th. Monday, February 21st is our draft. That's going to be an interesting one because obviously all of the carnage, everything that we've seen in the market. I haven't put a whole lot of thought into that one just yet. We'll get to that later in the week. Anyhow, check this out. Love to have you sign up. Again, 30 days, really no risk whatsoever. This you do have to give credit card for, so we can get you set up in our system, but we will let you know before your 30 days is up. We don't want you to just keep being charged on your credit card just for the sake of being charged. If you're not enjoying the service, honestly, we don't want you to be part of the community. And we're not for everybody. I know my style is not the same as everyone else's, and that's fine. But anyway, check that out if you haven't already. All right, let's take a look at what happened on Friday. It was not pretty. Dow Jones Industrial down 503, S&P 500 down to 85, NASDAQ down almost another 400 points. That came on the heels of a big reversal on Thursday. We had the CPI report. We pulled back at the open and then made a furious rally, went all the way back up into positive territory, and then the carpet was pulled out and ended up losing, 300 points on the NASDAQ from that high. and then another 400 points on Friday. So it was a very, very quick, swift reversal. And if there's one thing that's a common denominator in every bear market, whether it's cyclical or secular, impulsive selling. It's like everything's fine, and then all of a sudden, nobody's buying, and the market just completely craters. You get these all the time. You get these swift moves to the downside, then you'll get a quick move back to the upside. You think everything's, starting to calm down, it's all better again. You jump in, and then you get in another one of these big slides. Got to be really careful and very timely if you're on the long side. You've really got to have good timing. All right, mid caps down 34, small caps down almost 3. So on a percentage basis, mid caps did better than the other major indices, and small caps were best of all, losing just 0.2% on Friday, which was pretty good. Meanwhile, you saw the NASDAQ drop almost 3%. So big divergence there in terms of performance of our major indices. As far as sectors go, energy, the big winner. This whole Russia thing, invading Ukraine or on the verge of invading. We've got, anytime you get these geopolitical concerns, normally crude oil prices take off. Energy companies already on fire from a technical perspective. So this is really the only group, as far as I'm concerned, maybe financials a little bit, consumer staples a little bit. Those are the 3 main areas where there's strength. The problem with that is that these 3 areas are not weighted very much in the S&P 500. The areas that are weighted heavily, technology and consumer discretionary. And you can see what's happening here. And that's why the S&P 500 and the NASDAQ are looking like they're looking. For the longest time, though, some of these large cap growth names, the ones that really make up the lion's share of the S&P 500 and the NASDAQ 100, many of these companies held up very well. The Apples, the Microsofts, the Googles, the Teslas, these were companies that basically held up the entire S&P 500 on their shoulders. Now, many of the value stocks were going up, but they're not nearly, weighted nearly as heavily. The ones that are weighted heavily were the large cap growth, and those had been holding up pretty well until this month. I'm going to show you a couple of charts in a minute on that. Anyway, communication services and materials, also rough days on Friday. 10-year Treasury yield this morning. There's no economic news out, by the way, today. We do have the PPI coming out tomorrow, Producer Price Index. So another inflation report. Probably not going to be very good. I would not be expecting any positive inflation reports for the next couple of months. And I think that's going to continue to weigh on the market. It's going to keep the Fed in the limelight. And the Fed right now is hawkish, so we don't want them in the limelight. There's nothing really going on that's any good right now from a news perspective, and that's not going to help. The 10-year Treasury yield went up at the end of last week, went above 2%. That's another something that we didn't need in the market. Now, 2%, is that, an incredibly high interest rate? No, actually, it's an incredibly low interest rate historically, but it's going the wrong way right now. It's going up. We've got the inflation fears. We got the Fed fears. And so moving to a high on the 10-year Treasury yield that we have not seen in more than a couple of years, the market didn't like it. And so we're going to have to deal with that as well. Now, the rates moving up here, look at the financials, breaking out to a more than 52-week high on a relative basis. So this is good for financials. The rates going up is good. I think if you look at the spread between like the 10-year Treasury yield and like a 1-month T-bill, that's been going up nicely, and that's what's benefiting the financials. So as long as that continues, we should be in pretty good shape there. Industrial still struggling. If you look at the transport struggling. What is that telling us? If the Fed is going to raise all these times that they're talking about, I don't believe they should, but we're going to get so much talk about high inflation. We already got the numbers that show that we've got inflation. I don't think it's going to last nearly as long as everybody else thinks, but hey, that doesn't matter right now. What matters is the talk, the rumors, and it's not just going to be rumors. I think Fed's raising in March, and you might even see a 50-point boost in rates. There's not going to be any evidence, in my opinion, between now and March, their March meeting, that inflation is under control. So they're going to raise. I don't think there's going to be anything that's going to show evidence of inflation dropping probably for the next couple of months at least. So expect, I would say maybe two. I was thinking one rate increase, but I think maybe two. And then let's see what happens with the data. We might get a little surprise. A lot of folks calling for 7 rate hikes. I would be shocked. I tell you, if we get 7 rate hikes, expect a recession. Because consumer confidence, I don't know if you saw last week, was horrible. Came in way below expectations, and it was the lowest in many months. I don't remember how many, but it was not a good consumer confidence. And if you keep raising rates and inflation's going up, and then you got the whole Russia-Ukraine thing, consumer confidence goes down, and then you start thinking recession. Now, for those of you who don't realize it, 1960s, I think we had 3 recessions in a secular bull market. So the big R word might be the next thing that the media grabs hold of and takes and runs with. But I am not 100%. I don't like to use 100%. I don't like to use guarantees. I'm 90% feeling pretty optimistic that in a year, maybe a little over a year, I don't know exactly when, we'll be at an all-time high on the S&P 500. I believe that. Between now and April, who's to say? I don't know where we're going to be. We could be 3,800. We could be 3,500. We could be less than that. I think the market's got some issues to deal with. All right. So the S&P 500, I talked about some warning signs that came up the end of the year, and I've talked about it a lot. If you've been listening to me, you probably know most of them. I just threw, I don't know, a handful, 6, 7 of them on this one chart here. So you could see the last move up right here in the S&P 500 from November to December. See that? And then look at the growth stocks, small growth stocks versus value. I mean, we've been going down on this since back when inflation first started rearing its ugly head back a year or so ago. But just look at the last high here, S&P, growth stocks versus value, small cap level going down. Growth stocks versus value stocks at the mid cap level going down. Growth stocks versus value stocks at the large cap level finally going down. This is what I was talking about, carrying the market almost all year. Look at growth stocks, the large cap growth stocks. They were outperforming large cap value all the way until the beginning of December. And then we started to roll over again. We saw some final highs recently by Apple at the beginning of January. They set a new all-time high. Google, when Google came out with earnings and it jumped up over 3,000, set an all-time high. These were some of the things that we saw, but they were the final, that final thrust that the bulls had to the upside, in my opinion. I don't think we're going back up there, at least not in the near term. Then we go down here, the IWF, IWD. This is large cap versus large cap growth versus large cap value. Pretty much the same thing that you see on this chart. So these are fairly interchangeable charts. So I wanted to they look almost the same. XLY, XLP, consumer stocks. All of a sudden, in the month of December, remember, we're still here in December while we're going up to this all-time high. So just left of this blue dotted vertical line. And look what the consumer stocks were doing. Wall Street's moving out of consumer discretionary and into consumer staples while still talking about all these great deals on CNBC. I'm not going to go there right now. Transports, utilities going down. Normally, you would see this going up. So all of these ratios, which normally would go up to support the S&P 500 going up, were all going down. And so what happened? S&P 500 started going down. And if you notice, Friday, we went back down below that 20-day. When we have the 20-day below the 50-day and you have price action below the 20-day, I would not be in the market long. Maybe if you get down, you're down after a while and you've sold off and you get a hammer, or you have a 60-minute positive divergence, or you hit a major support level, hammer right here on 4,300 again. Maybe we bounce off of that. But generally speaking, when you're trading below the 20 and the 20s below the 50, that is a downtrend. That is not the same as moving up above the 20 when the 20 is above the 50. That's clearly an uptrend. This is the pattern you want to trade on the long side. This is the pattern you really want to trade on the short side until it changes, until the market tells us something different. So you got to be careful. And as you look, as we're moving lower, I mean, The growth stocks continuing to move lower. Small cap actually held up a little better on this last move down, but they were hit pretty good back in January. But you can see holding up a little bit better. Look at the large cap versus large cap value, ready to break down again. The S&P 500 hasn't broken down. If this ratio breaks down, I think the odds of going below 4,300 begin to increase quite a bit, because the S&P 500 is comprised, I think, was it 27% of the S&P 500 is like 10 stocks, which include Apple, Microsoft, Google, Tesla, Facebook, NVIDIA, PayPal, Adobe, missing a couple others in there. Actually, Berkshire's in there, which is not one of the growth stocks. But anyway, 8 of the 10 top weighted stocks in the S&P 500 are these big growth companies. Amazon, I may not have said Amazon in there. Anyway, these charts are all starting to turn lower, these large cap names. And if they're turning lower, the S&P 500 is not going to go higher. Energy, financials, consumer staples are not going to lift the S&P if Apple, Amazon, Google, Tesla, and those companies are going down. It's just almost a mathematical certainty. IWF, IWD, there you can see almost another breakdown. XLY, XLP rolling back over again. And you can see, look at these bottoms, this bottom in particular, double bottom right there. The S&P 500 was going up. Was Wall Street moving back toward consumer discretionary? No. Now, the last one, yes, they did, but already rolling back over again. Transports, utilities rolling over. I don't see anything positive in any of these ratios to make me think that we're just going to turn right back up and go above 4,600 and, you know, everything's good in the S&P 500. I don't see it. If I saw it, I'd tell you. I don't see it. Doesn't mean we can't do it. Market can do whatever. Maybe it goes up and all these ratios turn higher. Maybe it goes up and the market and the ratios keep going down. I'm not sure how that happens, but maybe. I guess anything can happen. Next up, so we got the PPI coming up tomorrow. And so I thought what I'd do here on the S&P 500, I wanted to show you the CPI. This is the core CPI and the core PPI down here at the bottom. And it's a 12-month rate of change. This chart is a monthly chart going back 50 years, 1972 to 2022. And so there's your S&P 500. And what I did is I put in these blue dotted vertical lines where we see core CPI top and start to move lower. Now, I didn't do every one of these, because if you look over here, here's 2% threshold. I mean, if we're topping just a little above 2%, rolling over, like right here is almost right at 2%. I didn't really pay attention, even though that helped. I mean, you see the S&P went up after that. I'm looking for, and even this one maybe is a little bit, you know, maybe I should have ignored that one. But these are all up at about 5% or higher. And of course, many of them were many, many years ago, 1970s, 80s, and 90s. But one thing that you'll see is that when the core CPI peaks from an elevated level and starts moving down, these are the moves the S&P 500 makes. This one, 45% in, I don't know, maybe 6 months. Now, that was coming out of the huge secular bear market in the mid-70s. I'd probably throw that one out. I think that's maybe a little bit of an outlier. But these others, right here where we peak, this is measuring from here to here. I just moved it way over here so you could see the number and not clutter the chart. You wouldn't be able to see the chart. But here, from here to here, we went up about 28% in less than a year, maybe 8 months. Here, we went up 30% within a year. I'm talking about after we peak on the CPI. Here in 91, we went up almost 30% after this peak started rolling over. Here, we went up 22% within a year after this peak, although again, that one's not, it's probably from 3%, so it's not really that high. But here we are, and I'm waiting for this top. And I don't think we're going to see it for another couple months. I think maybe beginning of April is when we could see the top, based on the way I'm looking at it. So I think March, April, if we're getting hit hard in the market and you've got a handful or, you know, stocks you like, you might want to start buying little pieces of it or of them. And that's why I think this weekend's event, the growth stocks, will be a big event, because I'm going to tell you some of the companies I'm going to be looking at. companies like Tesla. Yeah, I'm a fan of Tesla. Would I buy it right now? No. Market's, in panic mode, fear mode. And I think we're in a cyclical bear market. I think we're going to get Tesla at a cheaper price. If Tesla goes right back to 1,200 and I don't have it, I'm going to be kicking myself. But I don't see it. I see it going lower. I see the market going lower. So I think I can get a better price. So I'm going to wait. I'm going to have patience. Anyway, right now, I think this inflation number clearly has spiked more than at any point over the last 40 years. And so when we top, I believe we're going to see a pretty good rally in the S&P 500. And I believe it'll be led by growth stocks. I don't show you the growth stocks on here, but growth stocks tend to do very well when inflation rolls over. And that's because the interest rate expectations get lowered. And as a result, if interest rates come down, or even if you stop expecting rate hikes, all of a sudden you start changing your valuation methods. The parameters and things that you use within your valuations change. If you're expecting rate hikes, that's going to lower valuation of growth stocks. If all of a sudden you say, well, you know what, we're not going to have the rate hikes we thought, all of a sudden those valuations explode to the upside. So that's what we're going to be looking for. And again, it's going to take some patience. Here is the consumer price index on stock charts. I just wanted to show you this is how you can do it. First of all, dollar CCPI, core CPI. The PPI will be CPPI, core PPI, after $2 signs. Anyway, I always do the monthly chart here because they get released monthly. So that's the time frame that you want to use. And then coming down here, you can put, you can use candlesticks. And then you can kind of see, if you use a shorter term chart, you'll be able to see the moves a little bit better. Anyway, candlesticks there. And then down below, I use a rate of change 12 months so I can get the annual inflation rate. And then that's basically it. I mean, it's a pretty easy chart to put together. That's the CPI, core CPI. Here's the core PPI. You can see the inflation there, also 40-year high. So we're not going to get away from the headlines. Just be ready. I mean, this is going to be hyperinflation, 1980s, blah, blah, blah. That's what you're going to hear, or 1970s, I should say. I don't believe that's what we're going to have, but that's what you're going to hear. So let's talk about the growth stocks here. Here's the large cap growth index. And to me, this is the big problem now that we have to deal with technically. And I'm going to pull up on here a price relative chart. I'm going to use the DJUSGL versus the S&P 500. And let's use a line chart there. And then I also want to show you something where we take the DJUSGL versus the DJUSGS, large cap growth versus small cap growth. And let's look at this. So here is the growth stocks, and you can see it, coming down, and it rallies back, and then it rolls back over again. What you don't see from this chart right here, and you may not realize unless you actually looked at a relative chart, growth stocks at the large cap level relative to small caps have now moved down to about a 2-month low. All of a sudden, large cap growth was fine. And now as we start February, everybody's thinking, oh, the S&P 500 bounces off of 4,300. Everything's good. We found our support level. We'll go higher from here. I read a couple articles over the weekend, and I'm just looking at that. And I'm looking at this right here, and I'm saying, that's going to be interesting to see how the S&P 500 breaks out and moves higher, with growth stocks absolutely beginning to fall apart this month. Because these are the stocks that have been carrying the S&P 500. Now, all of a sudden, we've got them starting to roll over. Thursday and Friday were brutal with some of these large cap names, if you weren't watching. Apple, how about Apple? Those 2 days still, I think Apple actually is still one of the better performing stocks among all of the large cap names. I mean, Apple is single-handedly helping to hold the S&P 500 up, but it's got an inverse head and shoulder, left shoulder, neckline, head, neckline, right shoulder. If this doesn't hold and we make another move down toward the 150s, it's going to be really rough for the S&P 500 to hold up. How about Microsoft? Microsoft, Rolling over, really struggling even get through its 20-day moving average. I see it downtrending here. If it loses 280, that's going to be a big, big blow to the bulls. So I'd be a little careful there. Google, remember that gap up with its earnings all the way up here to 3,000? Everybody was excited. We've had nothing but filled candles since market just opened. We're getting a Google chart here. Anyway, you've had nothing but filled candles since, meaning there's been mostly distribution. So everybody using that strength, Wall Street anyway, using that strength to get the heck out of Google. So Google taking a hit. Amazon never really was in very good shape. Big breakdown, went to the 50-day. Now it's rolling over back below its moving averages. Facebook, well, this is a pretty chart. After they came out with their earnings, got absolutely massacred to the downside, continues to go down. Not looking good there. NVIDIA, big semi name. This has held up fairly well, but it looks to me like it's rolling back over beneath the moving averages. You're beneath the 20, the 20 is beneath the 50. Be careful. PayPal, another one. This one's been awful for quite a while, all the way since back in July. But the latest gap down, it just continues to move lower and lower and lower. I mean, the list goes on and on, but these are the companies that are the biggest weightings in the S&P 500 and in the NASDAQ 100. And here they are just getting mostly trounced or on the verge of it in the case of Apple and some of the others. Google, which was 52-week high a week and a half ago. These companies are all starting to roll over. So anyway, the market's got some issues here. One last thing I'll talk about, I wanted to just show you the chart lists. And we'll take a look at the charts that are on this chart list kind of as our 3 you must see. What you can do as you don't have to be you don't even have to be a paid member at EarningsBeats to get these upcoming earnings chart lists. If you're a EB Digest, our free newsletter, we will give you a link in that newsletter, which brings you to this page where you can then download these earnings chart lists, which I think are really cool. Here you can take this password, which I'm going to copy because I have not downloaded this yet. And this is Monday mornings. This is Monday morning's earnings. The next link is going to be Monday afternoon and Tuesday morning, Tuesday afternoon, Wednesday morning, Wednesday afternoon, Thursday morning, Thursday afternoon, Friday morning. 5 different chart lists. And what you can do is when the market opens, you can see how the companies that just reported either the night before or this morning, obviously none reported last night, it was Sunday. So it's just this morning for this list, but you can quickly see how they've all changed. So anyway, I just copied that. Let me hit this link. And so I hit paste with that password, unlock. Now I've got these companies. I'm going to save this to a chart list. If you're a chart list or if you're a stock charts member, I can go in and replace a list. I'm just going to take one of these old ones. I can change the date later. I'm just going to put it in here to this upcoming earnings 27. And then I'll have to change the name. But there, save results. Okay, it's saved. So view my chart list. And here they are. So here's the 5 companies that just reported. And then what you can do is once you have this in summary form, hit the change and you can see, okay, Treehouse Foods, we are what, 3 minutes into the market. Treehouse Foods is up 6.5%. Oh, Weber down here down 14%. Imagine having 100 charts that you're trying to follow earnings, because that's what it's going to look like later this week. You can quickly sort. The other thing you can do is you want to say, okay, well, how did the really strong relative strength companies do? Well, the higher the scooter, essentially higher the relative strength. And you can see this one was the highest of the, not really any of them very high. But this one, 22, this is 9. I mean, is this just like a sell on rumor, buy on the news kind of event? Let's take a look at Treehouse Foods. That was up 6%. Yeah, I mean, it's been downtrending. Now it's getting a bounce with its earnings. Probably is a sell at the 20-day. I mean, I'm just saying, haven't really looked at it. But anyway, there you have the earnings chart list that you can take a look at. So that was the first chart. Let's look at a couple of others. Just do it for our 3 you must see. Let's look at Weber. That was the one that was getting hit pretty big to the downside. Yeah, we got a breakdown. It's been downtrending. I mean, look at the relative strength. It's been horrible going into its earnings, and now it gaps down. One thing I've said, if I was holding a stock, wondering whether to hold it into earnings, and I saw this This is the stock relative to its peers. Going down, I would never hold. I don't care if it gaps up 50%. I would not hold a stock like that into its earnings, just because I don't want to see the bad news might be really bad. And here you can see down 12%. I'm just not interested in losing that kind of money at the opening bell. I just think it's too risky. Now, if you've got an uptrending stock, probably your odds are a little better, but still it's a big risk holding into earnings. All right, and then the last one, let's just look at this. This was the biotech, ROIV. We got some support down here around 6.5. Stock made a huge run to $17 back in December, all the way back down near support though. Watch that 6.5 level. And to the upside, you got to get through this 20-day moving average. Until we do that, we got issues. All right, that is it. I appreciate everybody tuning in. Let's get a quick look at the overall market. I'd say futures were all over the place this morning. We're down, then we're back up, then we're down. That's what we got to get used to. NASDAQ now down 9 points. So it looked like maybe we're going to have a little rough start. Dow future or Dow stocks down, or Dow components down 142. So a little bit more selling there. NASDAQ, S&P both down 9. I don't know. See what anything. Oh, Expedia continuing to do well there, performing well. So that's back up to 197. Expedia looks pretty good on the chart, by the way. I'll give you that one final chart and we'll wrap this thing up. There was the earnings, big move up, came back down. I remember talking about it. If we had the gap up, wait for 190. That's your breakout area. I mean, even going back over here, 188, 190, low 190s, right around 190. Here we came down, it opened at 210, came all the way back down to 190. I think we probably go back up. Expedia to me looks like a pretty solid company. And they didn't really perform well when a lot of the growth stocks were performing well in 2020. So it could be Expedia's turn. Chart certainly looks pretty good. I keep an eye on that 20-day moving average. All right, that's it. Appreciate everybody tuning in. Please be careful out there. This is a crazy market. The volatility is going to be off the charts. I mean, you could be looking at, the Dow down 500, in the morning, up 500 in the afternoon, or vice versa. I do think the afternoon will tend to be weaker, as I've pointed out in the past. Afternoons, especially in downtrends, we tend to see weakness. So you got to be careful later in the day, especially if you see the market starting to roll over. All right. Take care, everybody. I'll be back tomorrow over at Stock Charts TV right there on your screen. That's where you can click at 9 a.m. tomorrow and get my next episode of Trading Places Live. Have a great day. Happy trading. Happy Valentine's Day. Take care.